Okay, let's unpack this. Welcome to the deep dive, where your curiosity meets our research.
And today's deep dive takes us into a fascinating report. It looks at, well, the enduring influence of the U.S. dollar on African economies and businesses.
Right, the dollar's long shadow.
Exactly. And more than just describing the situation, it also explores potential pathways forward. Our goal is to really understand this complex relationship, what it means for the future.
Precisely. Our mission is simple: to understand why the dollar has such a strong hold, how it tangibly shapes everyday life and the business landscape across Africa.
The real world stuff.
Yeah. And what concrete solutions are being considered, all while keeping the economic discussions hopefully clear and accessible for you.
Okay, so first off, what's fascinating to consider is that the dollar's significant role in Africa isn't like a recent development.
Not at all.
No, its roots go way back to the economic decisions made by African nations right after they gained independence.
Ah, okay. Within the framework of the global financial system back then, the Bretton Woods system.
Exactly. That system was key. And if you think back to that post-independence period, institutions like the World Bank and the IMF were, well, really central.
Right, the big players.
And their lending practices played a key role in establishing the dollar's prominence.
How so?
Well, in the early years following independence, specifically from, say, 1965 to 1974, a substantial portion, over half of the World Bank's lending, was actually for major infrastructure projects.
Roads, dams, that sort of thing.
Yes, exactly. Things crucial for development. And these often required financing in what were known as hard currencies.
Which usually meant the U.S. dollar.
Generally accepted, stable currencies, like the U.S. dollar. So that established a strong initial link right there.
So even when Bretton Woods itself, the system of fixed exchange rates tied to gold and the dollar, when that collapsed in the 1970s, the dollar's dominance didn't really fade away in Africa. Why did it persist?
Well, several interconnected factors were at play. Firstly, essential global commodities like oil and wheat.
Yeah.
They continue to be priced and traded almost exclusively in U.S. dollars. That's huge.
Okay, so pricing power. What else?
Secondly, the vast majority of international loans were still issued in dollars.
Right, so debt was tied to it.
Yeah. And perhaps surprisingly, even trade between African countries was frequently settled using U.S. dollars.
Really?
Yeah.
That seems counterintuitive. Why would neighboring countries use a foreign currency?
Well, it brings us to this idea of global network effects.
Okay, explain that.
Think of it like everyone using the same type of electrical outlet. If you wanted to switch.
Everyone else would have to switch too, otherwise it's pointless.
Exactly. It becomes impractical for one person or one country to do it alone. Because so much international commerce was, and still is, conducted in dollars, it became incredibly costly and complex for individual countries to try and move away from it.
The whole infrastructure, the habits, just favored the dollar.
Yeah, the established norms and infrastructure, it just stuck.
Okay, so the dollar's entrenched. But let's talk about the real-world effects. What does such a strong dollar actually do to African economies? This isn't just abstract theory, right?
Absolutely not. The impact touches so many aspects of economic life. Let's start with something really visible. Inflationary pressures.
Okay.
There's a direct and pretty significant relationship between a strong dollar and weaker African currencies.
That makes sense intuitively. If your local currency buys fewer dollars, then anything you import priced in dollars, it just costs more in your own money.
Precisely. And get this, for most African countries, over 2/3 of their imports, everything from machinery to medicine, you name it, are priced in U.S. dollars.
Wow, over 2/3.
Yeah. So when local currencies depreciate against the dollar, the cost of these essential goods just goes up. We even have a regional average.
Yeah.
A 1 percentage point increase in currency depreciation can lead to about a 0.22 percentage point increase in inflation within a year.
That's a pretty direct hit, almost immediate impact on the cost of living. And the report says sub-Saharan Africa actually has a higher exchange rate pass-through to inflation compared to other places.
That's correct. Basically, it means currency fluctuations tend to have a more pronounced effect on price levels there. And we saw some really stark examples of this just in 2023.
Like where?
Well, East Africa saw average inflation of 26.5%. Sudan faced a staggering 245.3%.
Whoa.
West Africa wasn't far behind, around 20.3%. You had Sierra Leone, Ghana, Nigeria, all grappling with really high inflation.
And Egypt, too.
Even Egypt saw inflation climb above 30% as this pound weakened against the dollar. So, yeah, very real impact.
Okay, so it's directly affecting what people pay for everyday things. What about governments? How does a strong dollar hit their books?
Primarily through the burden of public debt. This is a big one.
Okay.
A significant portion of public debt across sub-Saharan Africa, I think around 40% on average, and over 60% of external debt is actually denominated in U.S. dollars.
So it's like the import problem, but for debt.
Yeah.
If your currency weakens.
Exactly. The amount you owe in your own currency effectively just goes up.
Right.
Currency depreciation directly increases the local currency cost of both servicing the debt, paying the interest, and actually repaying the principal.
That sounds painful.
It is. By the end of 2022, it's estimated that exchange rate depreciation had contributed to an average rise in public debt about 10 percentage points of GDP across the region.
10 percentage points of GDP, that's substantial. The report mentions Kenya spending nearly 60% of its tax revenue on debt payments in 2022-23. That's huge.
It's a massive chunk, and that situation was definitely made worse by a weakening shilling.
And we've seen actual debt crises too, right? Like Ghana and Zambia.
Precisely. Unfortunately, several countries have faced severe debt crises in recent years, and currency depreciation against the dollar has been a significant contributing factor in those situations.
Okay, so higher prices, more expensive debt. What about foreign investment? Foreign direct investment, FDI. You might think maybe a weaker local currency makes a country's assets cheaper, attracts investors.
That's the sort of textbook theory, yes.
Oh.
But the reality on the ground is often, well, more nuanced.
How so?
While a devaluation could theoretically make local assets look more attractive price-wise, but the currency volatility that often comes with it can actually deter investors. They tend to prefer, more stable and predictable environments for putting their money. Risk aversion kicks in.
And I guess with the U.S. Federal Reserve raising interest rates recently, that probably doesn't help. Pulls money towards safer U.S. bonds.
It's a key point, absolutely. Lower global risk appetite, combined with higher returns available on safer U.S. assets, does tend to divert investment flows away from emerging markets like those in Africa. And while overall FDI flows to Africa were kind of stable in 2023, Nigeria, for instance, actually saw negative FDI flow.
Negative, meaning money left.
Yeah, as investors sold off their equity holdings. This was despite an overall increase in announced FDI projects, interestingly.
So confidence was shaky.
And another factor.
Yeah.
If there's a shortage of U.S. dollars within a country, that also makes it less appealing. Investors worry, can I get my profits out? Can I convert them back into dollars easily?
Right, repatriation risk.
Yeah.
Okay. What about trade? Buying and selling goods internationally?
Well, a strong dollar generally makes African exports more expensive for buyers using other currencies.
So potentially less demand for their stuff.
Could be, yeah. And at the same time, while imports become relatively cheaper in pure dollar terms,
they become more expensive in local currency because the exchange rate is worse.
Exactly. So that combination can often lead to widening trade deficits. They're paying more for imports in their own currency and might be selling less abroad.
Doesn't sound great for the trade balance.
It isn't usually. In fact, the IMF did some analysis suggesting that a 10% increase in the dollar's value, often driven by global financial markets, has historically led to nearly a 2% decrease in overall economic production in emerging African markets.
Wow.
And get this, imports actually dropped twice as much as exports in response to that stronger dollar.
Okay, so that's the big picture, but let's drill down. How does all this really hit the businesses operating on the ground in Africa day to day?
Right, the local businesses. They face a whole array of challenges. Firstly, there's the issue of just increased production costs.
Makes sense.
If a business relies on imported raw materials, machinery components, or if it has loans denominated in foreign currency, a weakening local currency just directly translates to higher operating expenses. We saw a really clear example in Nigeria. Consumer goods companies there reported an average surge of 67% in operational costs.
67% in just 1 year.
In just 1 year, H1 2023 to H1 2024. It's massive.
That must make planning incredibly difficult. Pricing, profits, that must be chaos.
Absolute chaos. Fluctuating exchange rates create this highly uncertain environment. It's very difficult to predict your costs, set competitive prices that cover those costs, and actually manage your profit margins.
I bet.
In fact, Nigerian firms reported a staggering, wait for it, 1,345% increase in their net finance expenses in the first quarter of 2024 alone.
1,300%. That's almost unbelievable, mostly due to currency swings.
Largely due to currency fluctuations, yeah. It highlights the financial strain.
And just getting access to capital, to money, must become a real hurdle in this kind of environment, too.
It really does. Borrowing in hard currencies like dollars becomes prohibitively expensive for many because the currency risk is just too high.
Right.
Plus, as we touched on earlier, many African countries are experiencing actual shortages of U.S. dollar liquidity within their financial systems.
So even if you want dollars to pay for imports, you might struggle to get them.
Exactly. It becomes difficult and costly for businesses to obtain the foreign currency they need.
Yeah.
And of course, if you have existing foreign currency loans, repaying them becomes significantly more expensive as your local currency weakens.
Another hit to the bottom line.
A big one. Leading Nigerian consumer goods firms, for example, reported combined foreign exchange losses that were equivalent to over 18% of their total revenue in just 1 year, 2023.
18% of revenue just wiped out by FX losses. That's crippling.
It paints a picture of a really, really challenging and volatile environment for businesses just trying to operate and maybe grow.
The report also mentioned something called the dollar doom loop. Sounds ominous. Can you explain what that means?
It is pretty ominous, yeah. It's a term used to describe a kind of self-reinforcing negative cycle.
Okay, how does it work?
So a stronger U.S. dollar leads to higher import costs in African countries.
Which fuels inflation. We covered that.
Right, which in turn fuels domestic inflation.
Yeah.
Now, to try and combat this rising inflation, African central banks often feel pressured to raise their own interest rates.
Okay, standard central bank move.
But here's the twist. Higher interest rates in the U.S. can make dollar-denominated assets more attractive to global investors.
So money flows out of Africa towards the U.S.
Potentially, yeah.
Yeah.
Leading to capital flight from Africa and further weakening African currencies.
Which then circles back.
Exactly. It circles back to pushing import costs and inflation even higher. Loop closed. Doom achieved.
So the very tools African central banks might use to stabilize things can actually end up making the problem worse. That's counterintuitive.
It's a really critical insight, I think, for understanding the limited policy options they often face. Their ability to independently manage inflation, control exchange rates, stimulate growth, it all becomes significantly constrained by these external dollar dynamics.
It sounds like they have very limited monetary policy autonomy in this situation.
That's a good way to put it. And the report also highlights something called asymmetric exchange rate pass-through to inflation.
Asymmetric, meaning it works differently one way than the other.
Exactly. It means that when local currencies depreciate against the dollar, the resulting increase in inflation is often much larger and kicks in faster than any decrease in inflation when currencies appreciate.
So bad news hits harder and faster than good news.
Basically, yes. And on top of that, inflation tends to be sticky. It doesn't recede quickly, even if the local currency does strengthen for a bit.
Man, that sounds incredibly frustrating if you're trying to manage an economy.
It really is. And the report points out this kind of paradox related to dollar-denominated debt and the ongoing need for many African nations to seek international aid.
How so?
The very mechanisms intended to support development, like loans and aid, can inadvertently become a source of long-term vulnerability when they're tied to a strong and volatile foreign currency, like the dollar.
Yeah.
It creates a kind of structural trap that's really difficult to escape.
Okay, the report includes a really useful table summarizing key indicators for specific countries. Let's maybe touch on a few examples to make this even clearer. Nigeria, for instance. It's a huge Naira depreciation in 2023 after some reforms, right?
Huge is right. A staggering 95.6% depreciation over the course of the year.
Wow.
And as we've discussed, this had a profound impact on consumer goods companies, soaring costs, massive finance expenses, FX losses.
And the policy dilemma there is pretty stark, isn't it? Devaluation might help exports, but
it inevitably fuels domestic inflation, which hurts everyone. And it can trigger capital flight if investors get nervous. It's a tough balancing act. And Nigeria ended 2024 with inflation still around 35%.
Okay, what about Kenya? Similar issues.
And more themes, yeah. Kenya faces considerable challenges from a weakening shilling, especially because it relies heavily on imports for essential goods.
So higher import costs hit consumers and businesses hard.
Directly. And Kenya also carries a substantial debt burden. We mentioned that nearly 60% of tax revenue going to debt payments. The weaker shilling just makes that worse.
South Africa. Now, they're part of BRICS, more industrialized perhaps. Are they immune?
Not immune, no. The rand weakened significantly in 2023 as well, about 12.4%. Their current account deficit widened. And they remain quite vulnerable to shifts in U.S. monetary policy because they have pretty large external financing needs.
So even a more diversified economy feels the pressure.
Absolutely. What's particularly notable with South Africa is how directly and quickly their currency, their bond markets, their stock market can react to news and policy decisions coming out of the U.S. It really highlights that deep global interconnectedness.
Egypt seems to be in a particularly tough spot right now. Severe dollar shortage.
Yeah, Egypt's grappling with a really challenging situation. A severe shortage of U.S. dollars internally, and a big widening gap between the official exchange rate and the black market rate, almost double at times.
That must cripple the economy.
It's having a major effect, contributing to high inflation, deterring foreign investment because of those convertibility concerns we talked about, and increasing the national debt burden. And global shocks haven't helped either.
Ghana. They had a debt crisis, but also this gold for reserves idea.
Right. The CD lost a lot of value, around 30% in 2023, over 45% since early 2022, leading into a debt crisis. The gold for reserve strategy is an interesting, innovative attempt to maybe bypass dollars for oil imports and build reserves. It has led to some CD appreciation recently, but underlying vulnerabilities likely persist. It's not a magic bullet for deep-seated economic challenges.
And Zambia. They defaulted in 2020 and took some drastic steps.
Very drastic. The default was linked to dollar-denominated loans and volatile copper prices. They've since had controversial IMF dealings and taken some pretty unconventional measures, reportedly using only the Chinese yuan for trade with China, and even banning foreign currencies from most local transactions.
Really? Banning dollars locally?
Yeah, reflects the severity of their crisis and a strong desire to regain monetary control and cut dollar reliance. But measures like that can also create, new problems and distortions.
And lastly, Angola.
Oil dependent. Heavily oil dependent. 95% of exports, over 60% of government revenue. They saw a big depreciation in June 2023, about 44%, which fueled high inflation. Limited dollar liquidity is also an issue there.
So the focus is on diversification.
That's the long-term goal, yes. Because that heavy dependence on one commodity, especially one priced in dollars like oil, makes them incredibly vulnerable to global price swings and dollar strength.
It really underscores that structural vulnerability for commodity exporters.
Absolutely. And all these examples show the difficult policy trade-offs leaders face. Trying to float the currency like Nigeria, the gold strategy in Ghana, Zambia's currency ban. Interventions often deplete precious reserves and sometimes have unintended consequences.
Right. Which brings us to the core strategic question, really. Given all these vulnerabilities, should African nations keep relying so heavily on the dollar, or is it time to seriously look for ways to reduce that dependence?
It's a huge strategic dilemma, and there are compelling arguments on both sides, honestly.
Okay, so what's the argument for sticking with the dollar despite the downsides?
Well, for one, the U.S. dollar is widely seen as stable, a safe haven currency. That's particularly attractive for countries that have maybe had issues with high inflation or instability with their own currencies in the past.
Like Zimbabwe's experience, maybe. They dollarized initially to get stability.
Exactly. That's one example where it was seen as a way to anchor monetary stability. Plus, you have those massive global network effects we talked about.
Where everyone else uses it.
Yeah, it's involved in roughly 88% of all foreign exchange transactions globally. That makes it incredibly difficult and potentially costly for individual countries to just opt out.
And the U.S. is a major trade partner, a big investor.
A huge market and investor for many African nations. And let's not forget, the U.S. itself benefits enormously from the dollar status, the exorbitant privilege, as it's called.
Exorbitant privilege, meaning?
Basically, because the world uses dollars, the U.S. can borrow in its own currency, often at lower interest costs, and benefits from things like seigniorage, the profit made from issuing currency.
Okay, so strong arguments for the status quo. But what about the arguments against relying on the dollar? The push for de-dollarization?
Well, the vulnerabilities we've spent most of this time discussing. Vulnerability to U.S. monetary policy decisions made thousands of miles away.
Right, like interest rate hikes.
Exactly. Loss of independent monetary policy control. They can't easily devalue to boost exports or act as a lender of last resort in their own currency sometimes.
And they're more exposed to external shocks.
Amplified impact of external shocks. Yeah, interest rates, commodity prices, geopolitics leading to depreciation, inflation, debt crises.
Plus the cost of actually using dollars for trade within Africa.
Can be substantial. Estimated at around $5 billion annually in transaction costs and complexity. That's money that could be used elsewhere.
And the debt burden again?
The increased cost of servicing dollar-denominated debt leading to crises, And those dollar shortages we mentioned, they can lead to damaging parallel markets, black markets for currency, and deter investment because of those repatriation fears.
So that U.S. exorbitant privilege
translates, in many ways, to African vulnerability. It fuels the argument for needing a more equitable global financial system.
And the report also flags a really deep issue: lack of trust in local currencies.
Yes, that's a fundamental barrier. It hinders de-dollarization efforts and even initiatives to boost intra-African trade using local money, like PAPSS.
People just prefer the perceived stability of the dollar.
Individuals and businesses often do, yeah, even when trading with their neighbors. Overcoming that trust deficit is a huge challenge.
Okay, so if a complete sudden break from the dollar isn't realistic for most nations right now, what are the potential pathways? How can they gradually reduce dependence and build more resilience?
The report outlines several key strategies. Firstly, and this is crucial, strengthening regional integration and really boosting trade among African countries.
Through things like the African Continental Free Trade Area, AfCFTA.
Exactly. AfCFTA aims to eliminate tariffs, reduce barriers, create this huge single market, 1.4 billion people, $3.4 trillion GDP.
The potential benefits are huge, right? More internal trade, less reliance on external markets.
Potentially boosting trade significantly, attracting more FDI, driving growth, reducing poverty, encouraging industrialization, all reducing the need for dollar transactions for many things.
And you mentioned PAPS earlier, the Pan-African Payment and Settlement System. How does that fit in?
PAPSS aims to directly facilitate cross-border payments using local African currencies. It links up central banks, commercial banks, fintechs.
So bypassing the need to convert to dollars for trade within Africa.
That's the goal.
Yeah.
Kenyan President Ruto has been a big champion of this. If it scales up, it could save that estimated $5 billion in transaction costs annually, speed up payments dramatically, and really boost regional trade.
But there are challenges.
Of course. Different regulations across countries, infrastructure gaps, political commitment needed everywhere, exchange rate volatility between the African currencies themselves, and that deep-seated trust issue again.
Okay, what else? Promoting local currency financing.
Yes, reducing the reliance on borrowing in hard currencies is vital. Development finance institutions, DFIs like the IFC, the World Bank's private sector arm are playing a bigger role here by providing loans and other financing in local African currencies. The IFC has committed billions globally, including about $3.6 billion in 25 different African currencies over the last decade.
So businesses can borrow in their own currency. It reduces risk for them.
Exactly. It reduces their currency risk, makes operations easier, less paperwork sometimes. But there are challenges, like how the DeFi converts the local currency back if needed. We need much more of this, and deeper domestic capital markets within Africa.
What about looking beyond traditional partners, diversifying relationships?
That's another avenue. You see discussions around BRICS potentially developing a new reserve currency or payment system. Egypt and Ethiopia have joined BRICS now.
And bilateral currency swaps.
Yeah, those are becoming more common. Like Nigeria and China have renewed a big one, about $2.4 billion. Zambia and China using the yuan for trade. Egypt and the UAE have one. Ethiopia and the UAE.
So direct country-to-country currency arrangements.
Trying to bypass the dollar where possible, yes. And then there's the whole world of central bank digital currencies, CBDCs.
Digital money issued by central banks. Lots of countries are looking at this. Right?
Around 130 countries, yeah.
Yeah.
93% of central banks are exploring it. Potential benefits could include reducing cash costs, maybe financial inclusion, more efficient payments.
Faster cross-border payments, too. Cheaper.
Potentially, yes. That's one of the big hopes. But there are risks, too. Privacy concerns, currency substitution if people prefer a foreign CBDC, impact on banks, how it affects monetary policy.
Yeah, it's complex.
And finally, just strengthening the basics at home, domestic policy.
Absolutely essential. Enhancing tax collection, managing public debt better, building up foreign exchange reserves, fiscal consolidations, structural reforms, the hard, unglamorous work.
What about coordinating exchange rates within Africa?
There's an idea floated about an African exchange rate mechanism to try and stabilize rates between countries and reduce settlement risks for things like PAPSS. And the really long-term dream, a single African currency.
That's the ultimate goal laid out in the Abuja Treaty back in 1991, with a target date of 2028 now passed. It's a huge undertaking.
Requires massive convergence, right?
Huge amounts of macroeconomic convergence, political will. It would likely need a phased approach, probably strengthening the regional economic communities first, maybe creating regional monetary zones as stepping stones, very long term.
So as we wrap up this deep dive, the picture that emerges is, well, complex. The U.S. dollar's influence in Africa is deep, multifaceted.
Definitely. Presenting a mix of perhaps some perceived benefits like stability in certain contexts, but also very significant vulnerabilities.
Right. Amplifying external shocks, driving inflation, increasing debt burdens, hindering trade sometimes, limiting policy autonomy.
Those are the main challenges of that dollar dependence, yeah.
But as we've explored, there are potential pathways forward. It's not hopeless.
Not at all. Things like greater regional integration with AfCFTA and PAPSS.
Actively promoting local currency financing, developing capital markets.
Strategically diversifying global partnerships. BRICS, swaps.
And crucially, continuing that hard work of strengthening domestic economic management and institutions.
Exactly. These strategies, they're definitely challenging to implement effectively, no doubt about it.
But they hold the promise, maybe, of fostering greater economic resilience across the continent.
And gradually, maybe, reducing that over-reliance on a single global currency. That's the hope.
So as you go about your day, here's something to think about. What might be the broader global implications of a future where African economies have greater control over their financial destinies?
Interesting question.
What could that actually look like for patterns of trade, for innovation and entrepreneurship, and really for the everyday lives of people across the continent? And what further questions does this deep dive spark for you about the evolving global financial system and Africa's increasingly important place within it? Thanks for taking this deep dive with us.